Welcome to vTalkInsight, Risk Sentiment Daily for March 2nd, 2026. Risk tone has turned clearly defensive as mounting private credit stress and geopolitical tension around Iran push investors towards safety, even while capital quietly rotates into new equity leaders and AI infrastructure. Across major assets, today's picture is decisively risk-off rather than merely cautious. U.S. equities ended the recent month broadly lower, with the S&P 500 down close to 1% and the Nasdaq off more than 2%, while volatility has crept back toward the high teens. That equity weakness is paired with rising demand for safe havens and a widening risk premium in credit, signaling that investors are not just trimming exposure, they are actively paying up for protection. A pronounced flight to quality is visible in rates and credit. The 10-year U.S. Treasury yield has broken below the 4% threshold and stayed there, helped by renewed demand from both domestic buyers and foreign investors who have added hundreds of billions of dollars of treasuries over the past year. At the same time, high-yield and investment-grade spreads have pushed out to year-to-date highs, and the banking sector has sold off sharply, underscoring market unease about the credit cycle. Yet this is not a blanket liquidation. Global equity markets outside the U.S. are printing or approaching new highs. Value and momentum factors are outperforming, and the S&P 500 equal-weighted index has made a fresh all-time high even as the cap-weighted benchmark slipped. That combination suggests a defensive, risk-off stance at the index level, but with active rotation under the surface toward cheaper regions, asset-heavy sectors, and select AI infrastructure plays, rather than an indiscriminate dash for cash. Private credit stress and contagion risks have moved to the center of the macro narrative. A series of warning signs is now in play. Dividend cuts and portfolio markdowns across major direct lending funds, rising non-performing loans, and liquidity mismatches that have forced vehicles like Blue Owl to restrict withdrawals. Years of rapid capital inflows and weakening lending standards are now colliding with higher defaults and falling base rates, squeezing returns and exposing structural vulnerabilities. The pressure is not confined to a single manager or strategy. The collapse of a UK non-bank lender, Market Financial Solutions, and the discovery of roughly £930 million of double-pledged collateral have highlighted both credit risk and potential fraud in parts of the market. Banks and listed asset managers with exposure have seen their share prices tumble, and the KBW Bank Index has dropped more than 5% as concerns build over how much private credit risk has migrated back onto regulated balance sheets. Retail investors are increasingly caught in the crossfire. Private credit strategies have been wrapped into exchange-traded vehicles and interval funds that promise easier access, but the underlying assets remain illiquid, creating a risk of steep discounts, forced selling, or gating if redemptions accelerate. European accounting rules that allow delayed recognition of losses may be masking some of the damage, raising the prospect of more abrupt repricing later if defaults continue to climb. There is an active debate over how far this can spread. On one hand, multiple large managers, including Apollo, KKR, and BlackRock, have reported dividend cuts and markdowns in their private credit vehicles, and stress has already spilled into bank and asset manager equities. On the other hand, some portfolios are anchored in senior, collateralized loans and investment-grade spreads have not blown out, suggesting the damage may remain concentrated rather than fully systemic. The key watch points now are redemption trends in semi-liquid funds, further failures among non-bank lenders, and whether more banks disclose sizable exposures to stressed private assets. U.S. Iran tensions and energy shock risk form the second major bearish driver. The U.S. has deployed its largest military presence in the region since 2003. Indirect nuclear talks have stalled, and both sides are signaling that limited strikes remain on the table. Recent attacks and protest crackdowns inside Iran add to the instability, raising the chance that miscalculation rather than deliberate strategy could tip the region into a broader conflict. Energy markets are particularly exposed. The Strait of Hormuz carries roughly a fifth of global oil flows, and several scenarios now contemplate at least temporary disruption if Iran attempts to close the passage in response to U.S. action. Analysts flag that a shutdown affecting 20 to 25% of seaborne supply would be a major negative shock for the global economy, with the potential to reprice both crude and inflation expectations sharply higher. For now, oil prices remain below the peak seen in late 2023, implying that markets are discounting these risks unless and until there is evidence of actual physical supply loss. Even so, a risk premium is building through higher volatility, stronger bids for safe haven government bonds, and renewed interest in gold and other perceived hedges. Investors are also watching political dynamics closely, including a coming war powers vote in Congress, which could reshape U.S. policy options and add another layer of uncertainty for energy-exposed assets. The third bearish driver is the broad risk-off flight to safety in assets. U.S. indices have given back ground after a strong prior year, with the Nasdaq down meaningfully in recent weeks and small caps underperforming, while safe haven flows into treasuries and gold have intensified. Government bonds have just recorded their strongest monthly price gains in a year, and buying in gold and silver exchange-traded funds points to a desire to hedge both macro and geopolitical tail risks. Rates and credit markets are reinforcing that cautious tone. The yield curve is flattening as 10-year yields drop below 4% on safe haven demand, even as shorter rates remain anchored by expectations that central banks will stay restrictive for longer. High yield and investment-grade spreads have widened to year-to-date highs, with particular weakness in tech and private credit-related names, signaling that investors are demanding more compensation for bearing downside risk. Sticky inflation data adds another layer to this risk-off positioning. The Producer Price Index rose 0.5% month-on-month. Core PPI has picked up to 3.6% year-on-year, and upcoming PCE inflation is expected to print at 0.4 to 0.5%, likely pushing the core rate back above 3%. With services inflation and specific components such as portfolio management fees and airfares still elevated, markets see less room for near-term rate cuts, which helps explain why investors are leaning into quality and liquidity rather than chasing higher beta exposures. Against this risk-off backdrop, one of the key bullish forces is the rotation to international and value equities. Global markets outside the U.S. have been outperforming since late 2024, with many ex-U.S. indices reaching new highs even as U.S. benchmarks have softened. The Nikkei has posted gains approaching 50% over the past year. Korean equities are up strongly this month, and the S&P 500 equal-weighted index has outpaced the cap-weighted version, signaling a broadening of leadership beyond a handful of mega-cap U.S. tech names. Europe and Japan stand out in this rotation. European value sectors, especially banks and industrials, are benefiting from fiscal support measures, with earnings per share growth for Europe projected near double digits into 2026. Japan combines political stability with fresh fiscal stimulus targeted at industrials, defense, and technology, and is seen as undervalued relative to global peers, particularly in banks and industrials that are leveraged to both global manufacturing recovery and AI-related capex. Valuations and factor performance are reinforcing the shift. The long-term valuation premium of U.S. equities over international peers has narrowed as U.S. multiples compress from the low 20s toward 20 times earnings, while many non-U.S. markets trade around 18 times with faster earnings growth. Since November, value and momentum factors have outperformed by double digits, suggesting that capital is rotating toward cheaper, higher cash flow businesses and away from crowded, expensive growth narratives. For allocators, these trends highlight the growing importance of regional and factor diversification in a world where U.S. mega-cap tech is no longer the sole driver of equity returns. The second major bullish driver is broad AI investment and efficiency gains, even amid elevated volatility. On the infrastructure side, demand is surging. Dell has reported a record $48 billion backlog in AI servers and is guiding toward as much as $50 billion in AI server revenue this fiscal year, while data center operators have delivered returns of around 20% year-to-date on the back of strong demand from enterprises and hyperscalers. Strategic deals and financing underscore the depth of this trend. Equinix and a major Canadian pension fund are committing $4 billion to acquire a pan-Nordic data center platform, betting on the region's renewable energy, security, and connectivity advantages as AI workloads grow. At the same time, OpenAI has secured an unprecedented fundraising round with backing from Amazon, NVIDIA, SoftBank, and others, signaling that large pools of capital remain committed to the generative AI theme despite shifting competitive dynamics. On the cost side, companies are experimenting aggressively with AI-driven efficiency. Block's decision to cut nearly half its workforce, framed partly as an AI productivity story, triggered a double-digit share price rally as investors rewarded aggressive expense reduction. There is evidence that AI adoption is dampening hiring in automation-exposed sectors and maybe muting wage growth and underlying inflation, which could eventually support a more benign rate environment. However, recent volatility in NVIDIA, debate over whether the current build-out is a one-off cycle or a multi-year trend, and emerging regulatory frictions around defense-related AI all remind investors that the path for AI leaders is unlikely to be smooth. To sum up, risk sentiment is firmly risk-off, driven by mounting private credit stress, unresolved U.S.-Iran tensions, and a broad flight to safety that is pushing sovereign yields lower and credit spreads wider. Yet beneath that defensive stance, capital is not standing still. It is rotating toward international and value equities and continuing to fund large-scale AI infrastructure and efficiency plays, even as investors become more selective about valuations and policy risk. The key watch points from here are the trajectory of private credit defaults and redemptions, any concrete disruption to Gulf energy flows, and how upcoming inflation data shape expectations for central bank policy. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.